Good afternoon, everyone, and welcome to the Monday Open, hosted by the Vantage private client team. My name is Ollie, and joining me here today is Tony. How you going, Tony?
I'm good, thanks. How about you?
I'm doing very well, thank you, mate. So, moving into the structure for today's video, we'll start off by covering the events of the last 2 weeks, obviously having missed last week due to the public holiday. We'll be focusing on the key market moving events and dissecting the price movements as a result. We'll then switch over to the week ahead, where we'll focus on any upcoming major events of the week and give our take on how we expect prices to react to said announcements. Following from there, we'll shift into the technical corner, where we'll put a spotlight on a couple different markets and speculate on potential price movements using our technical indicators. Then lastly, we'll move into our Q&A section where Tony and I will answer some of the most commonly asked questions we get from our clients. So without further ado, Tony, would you like to take it away with last week?
Sure, not a problem. We got quite a lot to catch up, so let's start with Europe. The European Central Bank's main refinancing rate maintained at the same level of 2.15%, which is on par with expectations. In the meantime, we also see the deposit rate, on the other hand, was a cut from 2.25% to 2%. So, in human language, what does it really mean? Well, you see, here's the thing. The main refinancing rate is the cost where banks can get that they when they deposit the funds into the actual central bank, whereas the deposit rate is the gain the banks can receive when they deposit funds in the central bank in there. So when the European Central Bank put on hold on the main refinancing rate while cut the deposit rate, this is a clear signal for the banks to inject liquidity into the market. This could put down the downward pressure on the euro. That being said, that given the current inflation rate in Europe is merely just 1.9%, the room for further rate cut is limited. This compare with the United States, for example, which is projecting at 2 to 3 rate cuts by the end of the year. Our analysts believe that Europe USD in the longer term could face the downward trajectory. As a result, German DAX up 0.19% to 24,323 points, while Euro USD closing on Friday 1.1393, down 0.44%. Now, Ollie, what are your thoughts on the impact of the ECB latest move?
Well, it's a bit of an interesting one there. So, in terms of movements over the last 2 weeks, we've actually seen an improved euro against the dollar, with the euro currently sitting up around 1.3% from its opening price 2 weeks ago. So, as many of the fundamental traders watching would know, this actually does go against typical expectations for when central banks do cut rates. But in this case, the euro actually did improve. From my point of view, I think this is largely down to positive sentiment around European markets, following many positive announcements earlier in the year regarding EU investment, that particularly being towards defence and military spending. However, the other main contributor to this price movement is definitely from a weaker dollar, which can in part be explained by the US employment data. So, Tony, I'll shift it back to you. Did you want to touch on how this moved the dollar?
Yeah, sure. Let's move to the United States. Now, two pieces of information came out. Now, first of all, is we're looking at the non-farm employment changes, generated 139,000 jobs, which is better than the actually forecast of 126,000, but it's also lower than the prior period of 147,000. Whereas the unemployment rate remains at 4.2%, in line with both forecasts and the previous period. So here's an interesting thing. On one hand, we have more job created, but on the other hand, we have seen unemployment rate remain the same. So this indicates the US labor participation rate has increased because the newly created job is just enough to absorb the new entrants while not reducing the unemployment rate. Now we're essentially looking at the US economy, therefore, is growing but not overheating, one that supports Fed's wait and see stance. Uh, Well, this obviously considered benefit the stock market. As a result, we're looking at in United States, SP 500 closed 6,007 points, up 1.17% after the news released, while Dow Jones closed 42,000 points, 42,809 points, up 1.02%. Nasdaq closed at 42,809 points, up 1.39%. Now, while we're at US, there's another piece of information also coming out that is the CPI year on year. We saw the actual figure at 2.4%, which is lower than forecast 2.5, but a little bit higher than the previous 2.3. You see, here's the thing. Although not Fed's primary measure of inflation, CPI is still considered as a soft inflation reading. This leads to less pressure on the Fed to raise or keep the rates high. And as a result, we're looking at US dollars index closing 0.44% lower on the day at 98.564. Now, we've talked a lot about the US. It's time to bring China into the picture. Now, one of the key things we came to our attention is US China trade talks negotiation. As a matter of fact, it's very limited information actually come out apart from both parties appears to be praising the progress made. So at least we know, well, they didn't punch each other in the session. Nobody comes up with a black eye, which is good news. For what we have been informed, however, was the rare earth mineral export deal has reached its final approval stage in exchange for the walking back from the US side for revoking Chinese students' visa. We also actually heard that the news came out that the 90 days deadline might be extended for some countries and regions such as the EU. Yet, despite the seemingly positive news, all three major indexes closed lower on the day. We have SP 500 close 0.27% lower at 6,022 points. We're also looking at Nasdaq close 0.37% lower at 21,860 points, while Dow Jones, on the other hand, barely moved, stuck at 42,865 points. To me, market simply just didn't get what they want to hear, and that's what happens. Now, one of the biggest, however, news that coming after last week is the escalation of the Middle East, namely Israel and Iran conflict. On the 13th of June, Israel launched a significant preemptive military operation against Iran. The Israeli Air Force executed hundreds of coordinated airstrikes targeting Iran's nuclear and military infrastructure. Iran's supreme leader, on the other hand, condemned the attack and vowed for severe consequences. This created uncertainty and risks for escalation. Ollie, what market would you be looking at following the development of Middle East?
Well, mate, I've been keeping a close eye on gold movements. So as you just touched on, the conflict has escalated very considerably towards the tail end of last week, which in turn has led to some buying on gold as traders are starting to flock towards a traditionally safe haven asset. So gold prices gained 3.64% week on week last week to close out the week at its highest ever close price towards 34.32. At the time of writing, gold prices are slightly down on the day, although it does remain around $60 off its all-time high towards 3,500, which I am expecting the price to retest. But yeah, how about you, Tony? Which markets have you been keeping an eye on?
Well, gold is indeed actually something very interesting, given the escalation there. But I think that given Iran's contribution, around 4% of the total global oil supply, escalation of a conflict would disrupt oil supply chain. As a matter of fact, I've just heard the news earlier today that Israeli airstrike has indeed hit the oil refinery in Iran, meaning that they're already targeting the actual Iranian oil supply. So I will be very much focused on the oil market in there. Well, in case the trader weren't watching, markets react very quickly on Friday when the news break out. We're looking at WTI crude oil close at 73.225, up 6.4%. Brent crude oil close 74.79, up 6.5%. So traders would definitely want to keep an eye on how this actually develops further. That will be for me for the last couple of weeks. Now, let's move on to this week here. we do have quite a lot of actual news that traders might want to watch out. Let's begin with Bank of Japan. On Tuesday, Bank of Japan will announce the rate decision. We're looking at the forecast will be remaining at 0.5%, whereas on Thursday, Swiss policy rate also going to be announced. In this particular case, we're looking at the market is forecasting actually the 25 points of a drop, so from 0.25% to 0%. Now, economics are anticipating that the BOJ will maintain the current rate. This is particularly under the current trade tension with the United States. Be aware, though, the BOJ's decision will, as usual, have impact on JPY strength as well as equity market. Hence, we need to actually factor the potential upside or lower side surprises. By the same token, traders who also want to watch out the actually Swiss francs movement once the policy is released on Thursday. Now, we also have a lot of actually event happening in Europe, particularly between UK and EU. So on Wednesday, UK CPI year-on-year will be released, whereas the action on the same day, EU will also announce the final CPI. Whereas the day later on Thursday, UK official bank rate will be announced. So where we are at the moment, let's have a look. So right now, as it stands, UK CPI previously sitting on 3.5%. Projection here is that we expect it to go slightly lower to 3.3%, whereas the current official bank rate is 4.25%. Now, the market is forecasting the Bank of England to remain where it is. On the other hand, the EU CPI, we're looking at a 1.9%. The market is anticipating to remain the same. So here's the thing. As we can see, the UK and EU are in two different kind of a situation in there. On the UK side, the inflation is well above Bank of England's 2% target range. This significantly delays its rate cut anticipation. Whereas the EU inflation stands within the central bank target range, meaning in comparison, British pound has a higher headspace for further rate cut compared with euro. We believe that fundamentally, in the long run, Euro British pound might be bullish. However, near-term movements of the pair might well be determined by announcement of this week. Now, if, for example, we're looking at UK CPI continues to grow higher, and that means we could expect certainty of further delay in BOE rate cuts, leading towards the British pound to be strengthened and the Europe British pound to fall in a short term. By the same token, if EU CPI, on the other hand, declines further, we could expect the ECB to go even more dovish, which weakens Europe. And again, Euro British pound can also fall in a short term. So, Ollie, how are we expecting currency market to react? What do you think?
Well, as it stands, the Bank of England is forecasted to hold their rates at the 4.25%. But this is where I think it gets a little interesting with the CPI data coming out just the day before. So as we know, the CPI is the UK's most important measure of inflation data and is used as an indication for traders of future rate movements from the Bank of England. So typically we would expect central banks to respond to low inflation by lowering their interest rates. And currently the UK CPI is expected to print at 3.3%, down from the 3.5 last year. So given that the rates were only cut last month in May, I'd be surprised if the CPI data does much to change expectations. However, it does play into the Bank of England's intentions to cut rates by a further 50 basis points over the course of this year. So if the data comes in as expected, I'll be expecting the markets to price in a rate cut at the next meeting and weaken the pound as a result.
All right, thank you very much for that. That's a good insight. Let's move on to United States again. On Wednesday, we have another big deal here. Fed is going to announce the fund rate. Now, again, in this particular case, we're looking at it's likely to remain at 4.5%. So here's a deal. Like the market is betting 75% probability for Fed to maintain its rate, although we are also seeing growing confidence that the Fed will cut the rate by December. So we have seen the US dollars weakened. As a result, the market is priced in, and we are seeing it reaching the lowest level in over 3-year period, while US 10-year Treasury yield falls below 4.4% in anticipation of easing monetary policy. Ollie, what are your thoughts on the Fed decision then?
Well, as you mentioned, Tony, the Fed is currently forecasted to hold their interest rates as they continue to battle inflation in the States. As we know, the Trump administration has been very vocal about the fact that they want the Fed to cut rates to avoid a period of stagflation. However, many economists have highlighted that the Fed can't ignore the potential impact of Trump's tariffs on the inflation over the coming months. So, this sentiment was also underscored by the rising Middle East conflict, with energy and oil prices now a key consideration for the Fed. I'm expecting dollar prices to remain relatively unchanged following the announcement, although I will be looking towards the US equity market over the coming weeks as the economy looks to contract.
Okay, that's pretty much actually, very good insight. And I was thinking of the same thing, particularly given the escalation of the Israel and Iran conflict in here. How much would the United States get involved? That's the question to be seen. All right, now back home on Thursday, let's move on to Aussie unemployment rate. Now we are looking at 4.1% for the previous figure. The market is expecting no changes on that there. So, Ollie, do you want to just share with us the key points on the unemployment rate?
Of course, mate. So for this one, I'll be looking at the unemployment data as an indication for future RBA rate cuts. As we've touched on in previous videos, the RBA has made no secrets about the fact that it's planning at least 2 more rate cuts over the course of the year, and a higher than expected unemployment rate would increase the likelihood of a rate cut at the next meeting. So what does it mean for prices? I'll be looking for a weaker Aussie dollar if unemployment is high, with traders beginning to price in future rate cuts.
Excellent. Not a problem. I think that wraps up all the news in here. So while we're at it, Ollie, why don't you give us a technical spin on the markets of a selection?
Of course, mate. All right, let me just share my screen with everyone here. I will be doing the technical section on MetaTrader this time around instead of TradingView. So everyone, please bear with me for this one if there's any teething issues on it. But to start off, I'll be looking on the pound against the yen. We've started off on our weekly chart here. So I've got the red line at the top and the bottom here. It's indicating a range-bound market from what I can see. Can see we had a support price, a support price down below here around the 184 and a resistance up around the 199 price point. So if we look back to around the tail end of March here, it's been in a steady uptrend and it's currently still sitting within that range. I want to condense this down into the daily chart to get a better idea of the momentum of this upward trending market. So we can see since around, it looks like start of April up here, it has been in an uptrend. It's raised up, came down to find support at multiple occasions around here, and most recently here and here. However, I did want to highlight a key price point up here around the 196. So it looks like this has acted as a resistance point on 3 separate occasions dating back to, looks like around the middle of May. So most recently, the markets did touch on this price, although it failed to close above this price, traded back down where it's now currently sitting at 195. However, the support price here was still higher. So it is an upward trending support price here, which is indicating to me a buy sentiment on the market. So I'll scale this into our 1 hourly chart here for a bit of color on it. So right now, actually, let me scale that back to our 4 hourly just here. So you can see up here, most recently touched on, looks like around the start of June, has been trending down. There was a bit of a sell sentiment coming towards the end of Friday, given the rising conflict, as we just touched on, and it has since traded up. Towards the start of the trading day, it is going down, although I am still expecting the larger picture buy sentiment to continue. So right now, I'm going to be looking for the price to retest around this 196 and break through. Once it's broken through, I'd expect it to take a downturn to try and find support around, hopefully around this 196 is where I'll be looking to enter into a buy. So the next market I did want to touch on here was the USD on the Swiss. Again, we are starting off on our weekly chart. So I'm looking at a range-bound market dating back to around the start of 2023. We can see it's touched on its resistance price up around the 0.91 and its support price around the 0.83 on multiple occasions over the previous years. However, I did want to focus on just down here around, I think this was around April this year, where it did break down this lower support level, came up to find a resistance price at the previous support, and it has since been trending down, which is indicating to me a downward trending market. This is also supported by our MACD indicator down the bottom and our moving averages. So I'll condense this down into our daily chart here to get a bit of a better picture of what's going on. We can see on our 100-hour and 50-hour moving averages, they are evenly spaced apart against our simple moving average. They all are evenly spaced trending down, which is supporting the argument for a downward trending market. So I'll look into this on the hourly chart now. So we can see towards the tail end of Friday, we saw a very downtrending market in light of all the conflicts. It did since rise up to reach a high just shy of the 0.814 mark before trending down, finding another support price and trending up. Most recently in the hour, it has seen a considerable drop. So for me, that is indicating that it is going to continue. Right now, I'd be looking for it to continue down toward testing towards its previous lows from Friday around the 0.8 mark. If this can continue through, I'll be looking into a sell and a continuation of the overall trend. All right, so that brings it to the end of the technical section just here. So we'll slide on into the Q&A section. Tony, would you like to take it away with question 1?
Yeah, sure, not a problem. Ever since actually the Middle East changes in there, I have been asked a lot about actually oil there. So one of the first questions I wanted to actually address here is what are the different types of oil products we can trade, and what are the differences that between them? So first of all, there are two major common oil benchmark. The first one would be Brent crude. The trading code would be UKO-USD, and West Texas Intermediate, the trading code USO-USD. Now, Brent crude is the benchmark used for the light oil market in Europe, Africa, and the Middle East. Originated from the oil fields in the North Seas, one of the biggest group that we all heard of, which is OPEC, for example, use Brent as their pricing mark. Now, West Texas Intermediate, WTI for short, is the benchmark for the U.S. light oil market, and this is sourced from the U.S. oil fields. This is a preferred measure in the United States. Now, both light oil makes them ideal to be refined into gasoline. The difference here, though, between them, although historically speaking, the Brent has been cheaper than WTI, the price of the two have been lately reversed somehow. However, according to the Intercontinental Exchange, ICE for short, Brent crude serve as the price reference for approximately 78% of a global traded physical crude oil, either directly or indirectly. Now, worth mentioning, during the time of a crisis, the spread blown out of the political uncertainty leads to surge of the Brent crude prices. WTI, on the other hand, is less affected because it's based on the landlocked areas within the United States. However, this isn't always the case. Hence, trader should watch out case by case. That's my side of the question. How about, Ollie, you take on the next one?
Of course, mate. I'll take away question 2. So what's the difference between a simple moving average and an exponential moving average? Well, in a nutshell, a moving average is a technical indicator used to smooth out price data and help to identify trends. So the main difference between the two is based on the weighting of recent data for the moving average calculation. A simple moving average will give equal weighting to all prices within a given period, as a result, making it less sensitive to recent changes. Whereas an exponential moving average will give more weight to recent prices and therefore will be more responsive to recent changes. So the golden question is, which one should I be looking at? As a general rule of thumb, the simple moving average is preferred by long-term traders looking for market trends, while the exponential moving average is preferred by short to medium-term traders looking for short-term trends and trading signals. Essentially, they're used in the same manner to create trade signals, although they hold different benefits based on the type of trader you are. All right, so that brings us to the end of the video today. The recording for this live stream will be up on our YouTube channel as well as in the VIP trading room later today. If you haven't visited our VIP chat room yet, please do. We post a lot of market content in there along with an overnight market summary each day. For anyone who'd like to sign up for the newsletter, please feel free to reach out in the VIP chat room or to one of our relationship managers directly. Well, that's all from me today. I'll catch you later, Tony.
Thank you very much for having me. Have a good one, guys.
Cheers.